I can guarantee that you are making certain mistakes in your trading that are completely avoidable, that are stopping you from becoming a consistently profitable trader. And the point of this video is to essentially fix all of those mistakes and correct them. And the hope is after you watch this video and once those mistakes are fixed, you are going to be a significantly better trader. And sometimes the best way to improve super quickly isn't to actually get better at any one skill. It's to just completely eliminate the easy and simple mistakes that you are making. I have mentored lots of students that have really, really good habits. They're good at certain skills within trading, but they have mistakes that are just limiting them. And those mistakes, once solved, right, can completely propel you to profitability. And that's sort of the goal of this video. And a lot of these mistakes can literally be fixed by the end of this video. Like once you're actually aware of them, you could fix them and you can immediately improve your trading. And the first mistake that I see a lot of traders make is randomness. They operate in a random fashion. What that means is they're randomly entering their trades, they're randomly exiting their trades, they're using random risk, and that's something we're going to get to a little bit later in this video, but they're operating in a random way. They're not operating in a consistent way. And it's interesting to me because if you want to be consistently profitable, that means you're making money on a week-to-week, month-to-month basis, even a day-to-day basis where you're profitable most days. That's ultimately the goal, right? How are you supposed to be consistent if everything you do is random? And you need to be operating within a very clear system. And as a beginner trader, you're not going to have a profitable system. So let's kind of go over real quick exactly what needs to be systematic. Well, number one, your entries. Your entries need to be systematic. What that means is when you're looking at the chart and you're deciding to yourself, hey, am I going to take this trade? The first question you have to ask yourself is, what's the strategy, right? Is it a breakout? Is it a retracement? Is it a 1, 2, 3? And by the way, I teach all of these strategies in my free 8-hour course that's on my YouTube. And that same course is on my WAP. So definitely go into the description of this video, hop into the 8-hour course that is on my WAP, completely free. It'll teach you strategies, entries, and all that great stuff. So your entries need to be systematic in the sense that you look at the strategy and you know that that strategy has a particular entry at a specific point. Like I'll just give you an example. For a breakout, let's say we get a move higher, we get a consolidation. Our entry for a breakout is always over the highs of the base. Our stop loss for the breakout is always under the lows of the base, right? That's just an example. You'll learn about that in the free course. It's systematic. I know where my entry is for every single breakout opportunity that I trade, okay? So your entries need to be like this. So do your stop losses, okay? So your stop losses need to be at a consistent point depending on the strategy you trade. For the breakout, the stop loss is under the base, right? That's systematic. We know where the entry, we know where the stop loss is for the strategy. Perfect. Now, exits, right? We can't be exiting randomly because what's going to end up happening is you're going to either leave a lot of money on the table or you're going to end up losing more money than you want to lose. So for me, in my experience, what a lot of students struggle with is when it comes to targets, right? Where they are in a winning trade, it's going in their direction, they're making money, and all of a sudden that trade starts to pull back, right? Like for example, let's say they get into the trade right here. That's your entry, right? That's your entry. And then it continues higher. They're making money. They're feeling good. It's not quite at 2-to-1 reward to risk or 3-to-1, or maybe their target is up here, right? But they're making money and they're seeing that green number, the P&L going up, the profit and loss, they're feeling good. And all of a sudden it starts to pull back. And on this pullback, right, they get super nervous. And what do? They end up kind of impulsively exiting the position. They get out just to see that trade actually go and hit target. And this ended up being just like a little minor pullback. Happens all the time. Now, this is completely avoidable. And this is what I mean by randomness. You have to remove this random impulsive exit. right? And the way to do this is to have a trading management plan, having a specific way you manage your positions. Again, this is also something I teach in my free class, in my free course. So there's different strategies. There's bar by bar management. There's raising it to a major pivot, right? This could actually be an interesting opportunity where once this pivot is formed, let's say your stop loss is down here, you raise your stop loss, right? Maybe that's a part of your trading plan. You wait for a pivot, continues higher, you raise your stop loss. But by just exiting randomly whenever you're feeling emotional, right, that's a mistake. You have to fix this. And something that I want to really emphasize here is that in the beginning, especially, if you're just starting out, your trading plan is not going to be perfect. You're not going to have the perfect management, the perfect entries, placing your stop loss perfect at every single time, or when you're in the trade, taking profits perfectly. It's not going to be perfect, but you need to start with some sort of plan, right? And over time, you're going to improve on that plan, right? You create a plan, you take, let's say 50 trades. You go back, you review all those trades, and you say, okay, how can I have improved my plan? How could I have made more money with these 50 trades? What do I need to change about my plan to make sure I do make more money? And then you change the plan, and then you take another 50 trades, and then you see again, okay, what could I have improved? And then again, you change your plan, take another 50 trades, improve, change, and then continue on that sort of path. And then after like 4 or 5 iterations of taking 50 trades and changing your plan, you're going to end up having a plan that's actually pretty profitable, that's actually making you money. But you're never going to come to that plan if you operate randomly. So what I would do is sit down and write down where your entries are, right? Write down the strategies that you like to take, where your entries are, and how you're going to manage your position, right? If it hits, 1-to-1 reward to risk, raise your stop loss to break even. If it hits 2-to-1 reward to risk, take 50% of profit, right? Something like that. You kind of have to experiment, figure out what works for you, but you need to have a plan for everything you do. Eliminate all the randomness. Review your trading. Maybe in the moment, review your trading and be like, oh, catch yourself. Hey, I just made a random decision. I can't do this in the future. Write it down what you did and improve on it. All right. So that's the first mistake. Make sure you're not operating randomly. Okay. Perfect. Let's go ahead and actually erase this just so we have more room. Next, another really, really big mistake, and this one's actually much more easy to kind of like avoid, is multiple time frames. Okay. People are not looking for multiple time frame alignment. Okay. And that's a mistake. People, and a lot of traders I see, are only using one time frame, right? That's a T, this is an F. Okay. You can't be using one time frame in your trading. You can't be looking at the 1 minute chart, looking at all the candles go up and down, and be like, oh, buy, sell, buy, sell. No, you can't be doing that. All right. I actually have Trading View up somewhere around here. Let's get Trading View in here. Hopefully you guys could see it here. All right. So on Trading View, you have this option where this drop down, right? And it's not just for Trading View, it's for literally like every platform in existence. You have all these time frames, right? Anything between 12 months to even 1 second. Now, you have all of these time frames for a reason. Take advantage of them. Why are you only using one? Like, it doesn't make sense to me. Use multiple time frames. The best way I can kind of describe this is like, let's say, I've used this analogy before. Let's say you're at the base of a mountain. Let's actually draw this, right? Let's say you're at the base of a mountain. Okay, that's our mountain right there, right? You're right here. And we'll draw it like that. We have all this landscape, right? Are you going to be aware of what's going on over here? Or what's going on over here? Or what's going on over here? Like, not really, because you don't really have perspective, right? You don't know what tree is over here, right? You don't know, like, assuming you can't see it from here, you're not going to be able to know what's going on. That's my amazing tree, right? But then let's say you move up the mountain, right? And now let's say you're over here. Well, now you're going to kind of have a more elevated perspective of what's going on. You're going to be able to see what's going on over here more or less. Maybe you're not going to be able to completely see everything, but you see a little bit, right? But you're still going to have, no awareness about what's going on over here. All right. Let's erase this real fast just to make it a little neater. Okay. Now let's say you're over here. Now you have a much more elevated perspective. You could see almost everything, right? Let's say you're at the top of the mountain. Now you could really, truly see everything, right? Let's actually erase this really fast, right? If you're at the top of the mountain, you could see what's going on here. You could see everything. You could see all the trees, all the rivers, all the animals over here. You could see everything that's happening on this side as well, right? You have a complete perspective of what's going on around you the higher up the mountain you go. The same thing applies for trading, and hopefully that analogy made sense. Hopefully you guys kind of understood that. The point that I'm trying to make here is that the higher time frames are kind of like you being at the top of the mountain. You have an elevated perspective, and to go closer to the bottom of the mountain to get maybe a more exact perspective, right, to see exactly what's going on at the bottom, you go to the smaller time frames. All right, so very important, look at multiple time frames, right? Take advantage. So what time frames should you actually be looking at? All right, well, I'll kind of just give you guys for day trading, right? For day trade, okay? I personally look at the 1 minute, the 2 minute, the 5 minute, the 15 minute, the 60 minute, and the 1 and the daily chart. These are the time frames I use for day trading. I start in the morning on the 1 minute and the 2 minute, then closer to like 12 p.m. or 11 a.m., 12 p.m. I use the 5 and the 15. And then towards the end of the day, I'm only essentially looking at the 15. And I'm always, while I'm looking at all of these smaller intraday time frames, I'm always keeping an eye on the hourly chart, the 60 minute, and the daily chart, because this gives me my elevated perspective. And then for more precise entries, strategies, and execution, I go to the smaller time frames. But I'm looking at multiple time frames always. You wouldn't believe how many times, it's a really good example right here, how many times where, let's say we have the 5 minute chart and we have the 15 minute chart, right? Where the 5 minute chart has, let's say, a really nice breakout opportunity. And the 15 minute is like something like, I don't know, let's say like this, where it's like a breakout failure or something. Or maybe better example, maybe, I'm trying to erase this, maybe the 15 is just straight up downtrending, right? And it's actually in a downtrend, where I'd be looking at the 5 minute chart and I'd be like, yo, that's a really good pattern on the 5. And then I look at the 15, I see we're in a downtrend, and then I avoid this trade. And I don't take this trade. I don't lose money on it because I'm looking at multiple time frames. Or another really good way of using it, and this is a little bit more advanced. If you've gone through my university, you probably definitely understand this. Whoops. But let me get the draw, right? Paint the line. All right, so let's say, for example, you have a buy setup on the 5 minute chart, right? And we have a nice rising 20 MA, and we retrace directly to the 20 MA. It's a nice buy setup. Like I said, if you guys went through my university or my free course, you understand this. If not, hopefully you'll still get the idea, but make sure you watch all that education. So let's say we have a nice looking buy setup pullback pattern on the 5, but on the 15, we're super extended, right? There's too much extension between price and the 20 period moving average, and we're really extended. I'll stop. I won't take this trade because we're so extended on the 15 minute chart. So I'll avoid it. And I end up, saving myself money because I'm not taking that losing trade. You guys get the idea. Look at multiple time frames and look for alignment. All right. Alignment. That's what we're looking for. We're looking for the time frames to all be telling us the same thing. All the time frames are bullish. Time frames are not extended. Time frames are all looking good. We're looking for alignment. All right. Always look at multiple time frames. Cool. Easy mistake to fix. Just look at more of them and make sure you have alignment. All right. All right, I think we're about like 15 minutes deep in this video. Let's do like 1 or 2 more of these mistakes. Let me get a quick sip of water. All right, very good. Next, let's talk about something that has to do with risk. And this is a mistake that a lot of people are making. Let's say you take trade 1, right? You have trade 1. You have trade 1, 2, 3, 4, right? And let's kind of separate these. Let's say trade 1 and 2 are really high quality, really nice looking trades. And trade 3 and 4 are lower quality setups. They're not as good as 1 and 2. Maybe they're good, but they're not perfect. And 1 and 2 are perfect, right? Let's say 1 and 2, they're really perfect. You decide to risk a little bit more money. You decide you really like the setup. Let's say you risk $200 on setup 1. Maybe setup 2, you like it even more than setup 1. You risk $300. And then setup 3 and 4, you don't really like them that much, and you only risk 100 on this one and 50 on this one. Okay, so you're risking 200 on 1, you like it, it's really good, you risk 200. 2, you love it, you risk 300. 3, it's okay, you risk 100. 4, you don't really like it that much, you risk 50. This is what a lot of people do. They will risk different amounts of money based on their opinion on the trade, their opinion about the quality of the trade. This is a no-no, huge mistake. You guys need to be risking the same amount of money for every single trade that you take, okay? So let me kind of correct this real fast. So it doesn't matter how much you like the setup, you need to be risking the same amount of money on every single setup. So let's say our risk is $100. It's fixed. It doesn't change from trade to trade. You're risking $100 on every single trade. Remember in the beginning we said random actions lead to random results. Well, risking random amounts on trades is going to lead equivalently to random results. You can't be doing that. Risk the same amount of money for every single trade that you take. All right, and you might be thinking, well, why? Like, if I like this setup more, shouldn't I be more aggressive with it? Or if I don't really like this setup, shouldn't I be more passive with it? Well, number one, if you don't like the setup, you shouldn't be putting any money at all. You should only be taking high quality trades, right? So you have to be really selective. And then on the trades that you do take, assuming you're selective, they're high quality, right? Because those are the ones that you're choosing. You're being picky and selective. You have to be risking the same amount of money because we ultimately don't know which trades are going to follow through and work and make a lot of money and which ones aren't, right? We don't know. Sometimes there will be a setup that's like B+, that'll work much better than an A+ setup. We just don't know, right? Like we can't truly predict which setups are going to make the most amount of money. We can't do that. So that's why we need to act in a very systematic and consistent way, right? So hopefully that makes sense. Now, I also want to make one more point here. If you are risking different amounts of money for every single trade that you're taking, it makes it impossible to actually track, right? So let's kind of put an example. Let's say, again, you're risking, what was it? I forget, was it 200? Whatever the case is. Let's say 200 for this one, 300 for this one, and let's say 100 for this one, and the 50 here. Let's do profit, right? This is our profit. Let's say this one made you $600 profit. This one made you $500 profit. This one made you $150 profit, and this one lost you money. Lost you minus 50. Hit your stop. All right. When you're looking at how much you're making per trade, right? It's so difficult to figure out, did you make more money or on like for example, this one, you made 500 even though you risked 300. This one, you made 600 even though you risked 200. So Was it the amount that you're risking that's affecting your profit, or was it the actual strategies you're taking? Right? Hopefully this makes sense. It's a little bit difficult to explain, but what I'm trying to say is, if you're risking different amounts, it's going to be really hard to tell when you're looking back at your trading what is actually making you money. Is it the fact that you're just putting up more money in certain trades, or is it because that strategy and that setup that you're actually taking is genuinely higher quality than the other ones? You know what I mean? You have to keep it. You have to keep your risk an independent factor, and if you keep it independent, it doesn't change. Then you'll be able to see which dependent factors, right? If we're talking about like the scientific method, right? We learned this in school, but we're able to actually figure out what leads to us making more money, like what exact criteria that we're looking for in our trades, what exact setup, right? I hope that made sense. Makes sense in my mind, but if you're a little bit confused, I'm trying to figure out a like easier way to explain it. But essentially, it's hard to tell what is actually truly making us more money when our risks is different. Like you could have made $900 on that trade, and you'd been like, oh wow, I made 900, but was it because you risked more, or was it because it was actually an actually good setup? Versus if you risk $100, let me hold up. Let me erase this. Boom. Versus, let's say, right, you're risking $100 for every single trade, right? Let's just write that real fast. And you make 200. You make 300 on this one. You make 400. You make 50 on this one. You can look and be like, wait, hold up. On trade number 3, I made $400 on this. What about this trade? Like, what are the qualities of that trade that enabled me to make so much? Or okay, 300. What qualities about this trade made me that much money? 3-1. Okay, this one didn't work out as well. What about this trade didn't work out? What was the mistake here? What was the issue in the quality of the trade, right? And if you do this over like 50 or 100 times, it is so obvious what trades make you money, what setups, what criteria make you money versus the ones that don't. All right, cool. So always risk an identical amount no matter the trade you are taking. And let's do one that's really, really simple. Do one last one. This video is getting kind of long. One last one that's really, really simple is big mistake that people make is that, let's say your entry is right here. So entry. So it hits your entry. Let's say your stop is right here. It hits your entry, moving up. Then it starts to move down, but it doesn't quite reach your stop loss. But you get scared and you exit right here before it hits your stop loss. You end up losing a little bit of money on the trade, not your entire risk because it didn't hit your stop, but then it ends up moving up anyway. And you're like, yo, hold up, I don't understand. Why did I lose money on that? It didn't even hit my stop loss and I lost money on it. Why did I exit? I should have just let it hit my stop loss. If I was willing to take the full loss on my risk, I would have actually, if I was willing to take that, well, it wouldn't have actually hit the stop. I would have actually made money on it, right? So don't make that mistake. That kind of goes back to one of our points about random action. So yeah, if you're in a trade, don't get out before it hits your stop. Like, let it stop out, right? Let it fully hit your stop, because so many times it comes close to hitting your stop and then it goes back in your direction. Or another thing a lot of people do is it goes past their stop and they just stay in the trade. And then they add, right? And then it moves up, they're getting really excited, and then it drops, and then they add again. And then they keep adding as it's dropping, add, right, add. They keep adding, and all of a sudden, boom, they blow their account, right? So you don't want to be doing that. Hopefully you guys can understand this, like hieroglyphics, pronounced that wrong, but all of this handwriting, it's a little sloppy, but hopefully you guys understand what I'm saying. All right, so yeah, fix those mistakes, operate in a consistent way, use multiple time frames, risk the same amount for every single trade. Just make sure your entire trading plan is consistent, systematic, and you're actually following like a framework. And that's basically it. Like I said, guys, make sure you watch my free 8-hour course. Register for my live training. That's every single Thursday as well. And yeah, if you're looking to trade live with me every single day, you want to get personally mentored by me, if you want me to take you under my wing, go into the description, or actually send me a DM on Instagram. I'll post my Instagram in the description. If you want to get mentored and trade live with me every single day, just send me a DM on Instagram. And yeah, I'll give you more info about that. But hopefully you guys enjoyed this video, and hopefully you actually improved after this video.